From the significant drop in bond yields to a steady recovery in tourist arrivals, we bring you the latest economic updates for the month of June 2023. Hi, I'm Tarsha Ashoka and welcome back to the First Capital Monthly Economic Watch. On 29 June 2023, CBSL submitted a debt restructuring proposal to Cabinet, providing a clear direction on the DDO process and clarity to the investors. The proposal contained restructuring of central bank's treasury bills and government advances, which is to be converted into long-term bonds. On T-bonds, only superannuation fund holdings will be restructured, and this will also be in the form of extending maturities between 5 to 15 years. However, the banking sector's treasury bill and treasury bond holdings were exempted from the DDO as it has already borne a significant burden of the fiscal adjustment and the economic crisis in several ways. Following that, as expected, the Central Bank of Sri Lanka has decided to further reduce the standing deposit facility rate and the standing lending facility rate by 200 basis points to 11% and 12% respectively. The consecutive rate cuts during the latest two policy meetings are expected to reduce the market interest rates, particularly the lending rates, in line with the reduction in risk premium observed on the government securities during the recent few days, which is expected to aid the rebound in the economic activity in the coming months. Moving on to the bills and bond rates, the secondary market yield curve plunged across the board up to 50 to 600 basis points after CBSL eased monetary policy rates by 250 basis points during the first week of June. As the DDO draws closer, with the massive decline in government security yields, the significant premium that was previously available on the yield curve is no longer available. Meanwhile, weighted average yields at the weekly T-bill auction normalized to near pre-crisis level, where 1-year maturity plunged below 17% after near 13 months. This declining trend of interest rates movements reflected in finance sector rates as well, where AWPR decreased below 20% and recorded at 19.47% towards the end of the month of June, while interest rate spread declined to 4.4%. Despite the rates falling, private sector credit further contracted by LKR 88.9 billion, while state credit too displayed a contraction of LKR 43.4 billion in May 2023, expecting rates to further come down. On a year-on-year basis, private sector recorded a decrease of 9.46%, and on month-on-month basis, it is a drop of 1.3%. If we look at the inflation for the month, as expected, inflation also continued to display a declining trend for the 9th consecutive month to 12% year-on-year, while month-on-month inflation remained muted. Year-on-year inflation of food group has decreased to 4.1% in June 2023 from 21.5% in May 2023, while non-food group decreased to 16.2% from 27% in May 2023. Analyzing the month-on-month inflation, the CCPI index stood still during the month, offsetting contributions of the increase in expenditure of food items by 0.41% and decrease in non-food items by 0.39%. In food items, fresh fish, vegetables, chicken, green chilies and ginger significantly contributed to the increase. Meanwhile, non-food price decrease was mainly aided by housing, water, electricity, gas and other fuels, transport, furnishing, household equipment, and alcoholic beverages and tobacco. Looking at the NCPI for May 2023, NCPI further contracted to 22.1% year-on-year compared to 33.6% in April 2023. Moving on to foreign reserves, which marginally declined by $23 million and remained at $3.5 billion in June 2023. Meanwhile, market liquidity displayed volatility and turned negative during the month of June 2023. In terms of the government securities, there were $666.5 billion worth of maturities during June 2023 and new issues through auction worth of $737.5 billion, creating an excess of $71 billion. Meanwhile, CBSL holdings fluctuated and ended the month of June below LCAR 2,500 billion. Moving on to external sector performance, recovery was observed across the board from balance of payment to tourist arrivals. Looking at the trade balance, trade deficit amounted to $447 million in May 2023 compared to $403 million recorded in May 2022, recording a year-on-year expansion for the first time since February 2022. In terms of exports, earnings from exports marginally declined by 2.7% in May 2023 to $1 billion, mainly due to the decrease in earnings in industrial exports, including garments, amid slowing external demand. Meanwhile, import expenditure increased marginally by 1% year-on-year to $1.4 billion in May 2023, recording the first year-on-year increase since February 2022 on the back of import relaxations. The increase in expenditure on consumer goods contributed to the increase in import expenditure, while a decline in expenditure was observed in imports of intermediate and investment goods. BOP for May 2023 recorded at $714 million compared to April 2023 amount of $25 million. In terms of tourist arrivals, total arrivals for the month of June was recorded at 100,388, displaying an increase of 205.5% year-on-year compared to June 2022, and on a month-on-month, it is a growth of 20.5%. Continuous enhancement of air connectivity, followed by China's reopening and the strong pent-up demand, contributed to the growth. This is the first time in 4 years that arrivals cross 100,000 mark in the month of June, as usually May to October are considered off-season. The largest source market for tourist arrivals in June were India, the UK, Russia, Australia and China. In terms of the currency movement, although LCAR depreciated against USD on a month-on-month basis and stood at LCAR 308.8, on a year-to-date basis, LCAR strengthened against most of the major currencies, including USD, UK pound and Euro, supported by improved socio-economic conditions. Finally, moving on to the global market, a positive sentiment persisted as most major indices were seen recovering during the month. So with that, we conclude the monthly recap for June 2023 and stay tuned for more updates in future. Thank you.